Hello traders, Gary Wagner here, just after 1 o'clock in Honolulu, 7 o'clock in New York. It is Thursday, July the 2nd, 2020, and this is the daily report for gold and silver, our weekend review. We are coming to you one day early in celebration of the 4th of July here in the United States and Canada Day to our northern neighbors. This week was really filled with mixed messages. On one hand, we had very solid economic numbers coming out. Labor Department reported that 4.7 million new jobs were added last month. Concurrently, we have very, very pessimistic news about the current pandemic. The rise in the United States topped 50,000 new cases yesterday. That was the largest single-day rise since the pandemic started. And so these mixed messages have fueled markets that normally wouldn't trade in tandem. Equities and gold continue to move in tandem to the upside. We will talk about gold, silver, as well as GLD and Nugget all on today's show when we pull up our technical studies. But first, to the price board. This week, although a shortened trading week, was filled with mixed messages, as I spoke about in our opening letter. We had a jobs report coming out today indicating almost 5 million jobs were added last month. And at the same time, we had a report by the CDC that indicated the largest single-day spike of new COVID cases in the United States to date. The overwhelming concern as to when this pandemic will run its course, contrasted against the strong economic data, has resulted in the mixed messages that I'm speaking about, and that led to a record high close in the NASDAQ composite. Equities as a whole gaining tremendous ground this week, and so did gold and silver. So we have the safe haven asset group as well as the risk on asset group, equities, running in tandem to the upside. And that, I believe, is in response to an accommodative Federal Reserve, ECB, as well as other central banks. Gold closed up by $7.10 today at $17.87. That, of course, is basis the most active August contract. Spot or Forex gold gained $6 at $17.75. Platinum and palladium were lower. About a $7 drawdown in platinum, $827.50. About a $13 drawdown in palladium, $19.17, and silver gained just over 4 cents at $18.26, and that was with fractional dollar strength. Dollar strength gaining only 0.06%, and the composite closed at a new all-time record high of 10,207. Let's take a look at our technical studies. Precisely 9 years ago, in July, we saw gold run to the all-time record high above $1,900 per ounce. We're looking at a monthly chart. You can see that that rise is exhibited by this single green candlestick closing well above the tops that we have seen before gold's rise as well as after the rise in gold. This candlestick that we are going to look at right here, because this represents the first 2 trading days this month in July, but in June, the market closed at a high that has not been seen since July of 2011. We are truly witnessing a parabolic and dramatic rise in gold pricing that had really begun to occur approximately in the middle of 2018. Gold was sitting right at around $1,200. We are looking at close to $1,800 gold now. The explosive move that we have been speaking about that began in the middle of 2018 really hit a new gear when the pandemic struck back in March of this year. We're looking at a daily chart, and what is most noteworthy is the tact or angle of these recent rallies. You can see that beginning in March, the pandemic itself was basically a parabolic move up to these recent highs here. This coming in at approximately 1788, the former yearly high. Sideways trading action occurred for a couple of months, but then look at the angle or ascent tact that we're witnessing on current market scenarios. And in fact, what we saw today were further gains to the upside, taking gold approximately $7 higher. What is noteworthy about today's action is we did see the market trade with a lower low than the previous day, a lower high than the previous day, and although the market closed higher when compared to the opening price, what we can see is on a simple trend line in which we extend through the series of lows that come in, today's low came in at about 1766. That is a price point we've identified as a critical support level. However, it did break slightly below that trend line, and I believe that that occurred as the jobs report was released, announcing that a total of 5 million new jobs were added to payrolls in the United States last month. And traders, the last chart that I do want to look at on gold is going to be for my interim term projections, and they are based on a combination of Elliott wave count along with Fibonacci extensions. We use the wave count and measure the distance on this third wave, which occurred during March of this year when gold went from 450 to 1788. We then look at the correction that ended at the first or second week of June. That would be the wave 4. And then with the completion of both wave 3 as well as wave 4, we can run a projection or an extension of this third wave as expressed through Fibonacci numbers. We use a 61.8% extension of wave 3 to calculate where wave 5 might go. Our numbers come in at $1,880. The wave get system is a little bit more optimistic, coming in just about the record high at about 1920. And based upon our technical studies, as you can see, we are quite bullish to say the least. Let's take a look at silver pricing. Traders, to think that silver was trading under $12 an ounce as recently as the middle of March, we have seen the precious white metal come a considerable way. We saw it trade to a high of about $19, which was followed by a correction taking silver to approximately $17 per ounce here. And then we can absolutely identify really a rounded bottom in terms of a pattern itself. And that, of course, would indicate higher pricing. We believe in terms of our long-term forecast for silver, we are looking for silver to go to $20 or $21 per ounce. Lastly, all week we have been talking about alternate methods of investing in gold besides trading futures or buying physical bullion or coins, and that is the ETFs, GLD, and the miners ETFs, Nugget. In these two ETFs, I do like to use weekly charts as I analyze the data. First, to GLD, we can see it traded to a low in March of 136. It is now trading at 166.98. We have a minor gain on the week, but when we compare the low to the high, we see it traded to a high of 168. We continue to recommend that our subscribers and listeners rebalance their portfolios to include GLD. The one major caveat to GLD is although it represents incremental buying of gold, in other words, each share represents 1/10 of an ounce, when we have current gold pricing at $17.87, this is saying that gold is priced at $16.70, and so it obviously lags far behind the move in gold. Nonetheless, we see the same triple top in the ETF here, and we do see the top that came in just above 1900 as represented in the GLD came in at around 185 per share. And that is to say that the overall characteristic of the GLD is that it is much less volatile than the futures market itself. And to a much less extent, in Nugget, which is the gold miners index with a little bit of leverage, we can't say that there is less volatility than any of the markets. Take a look at the highs that came in back in 2011 and 2012. and contrast that to the activity between 2014 through current pricing. In fact, we have to greatly enlarge the chart to see any activity go from really a sideways pattern to see what's actually been happening. And even though gold was up today, Nugget lost 2.2%, a total of $1.71 per share, currently fixed at 76.14. But as you can see on this weekly chart, we have seen solid gains week on week for the last 3 consecutive weeks. And prior to this decline here, we had Nugget go from about 25 in March to cap over 80 in the middle of May. So those are the 2 ETFs we are recommending in terms of a rebalance of your overall portfolio. This has been Gary Wagner, wishing you as always good trading. And for those who observe, please have a great 4th of July or Canadian Day weekend. We will talk to you after the extended weekend on Monday. Bye-bye.